Hi everybody, Happy New Year. It's 55 degrees in Florida, so we're really suffering over here. It's actually beautiful right now. I love a little bit of colder weather. But welcome to our latest quarterly market update and outlook video. We got a lot to talk about because I didn't do a video in December, so we got a little bit of catching up there. But as you probably saw, the market went down a little bit in December, and it's a little choppy here in January. So what's going on here? Is this something that is going to persist here for the rest of the year, or is this just a little blip? So we're going to get into that today. I'm going to hopefully give you some color on how to answer that question. But thanks for tuning in, and let's get started. All right, so let's start off with the asset class returns for the month of December, which also concludes for the year 2024. So in the blue, you could see how for December, the market was down a little bit, which is a little surprising. December is usually a pretty good month, and the typical Santa Claus rally that happens right at the end of September and early January didn't take place this year. So that's what the title was we're going to get into. Is this little fade something that's going to persist, or is this more of a blip? But you can see here also in the green is the 2024 figures. We had a fantastic 2024. So that's 2 years in a row where we had plus 20% on the S&P 500, which is actually a pretty rare event. Last time that happened was 97, 98. Which actually had a third at 99, which was a pretty positive year. So we'll have to see if that can continue. But couple highlights, you can see real estate took a pretty big hit and small caps took a pretty big hit. The big news we'll be talking about with the Fed and interest rates and what's going on there. But you can see, ironically, emerging markets actually outperformed the U.S. markets. And commodities, but everything else across the board was down. So let's get into what's going on. All right, so before we get into some analysis here of what I think is going on, let me give you some of the most important economic data points that are out there. So number one, we have personal consumption expenditures. This is the PCE index. This is the inflation number that the Fed looks at the closest. This is the one that they use as their official number. And they're targeting 2%. So we had a number that just came out for December that was 2.4% year over year, up 0.1 for the month. That was actually pretty good. 2.4 is getting there, close to 2, but it actually ticked up a little bit from 2.3. So people are, wondering what's going on with inflation. It seems to be hanging in there. It's not going down as fast as people want. All right, the next big economic number is ISM manufacturing PMI. So you can see here the number was 49.3 versus the expected, which is at 48.5. So remember, anything over 50 means that it's growing, under 50 means it's contracting. So what we're seeing here is that the manufacturing is still contracting. It's been very slow, and this has actually been the trend for well over a year now. But it's starting to get a little closer to at least neutral and getting back into positive territory. That's actually pretty good. We haven't seen numbers close to 50 here in a while. Now, even more importantly, we have the ISM Services PMI. This is what shows how the economy is doing as far as services, which is 70% of the economy. So this is actually a more important number. And what we're seeing here is the number showed up for December at 54.1. That's actually a pretty good number. As you can see, the expectation was 53.2. And so this is a number that shows that we are growing very strongly in the services department, which is, again, the biggest part of the economy. So that's a really good sign. And then, of course, the latest is that we got the unemployment report as of today's recording, which is Friday on the 10th. And we had 255,000 new jobs for the month of December. The expectations were 154, and the unemployment rate went down to 4.1, and it was expected to stay the same at 4.2. this is actually pretty amazing. So why is it that the market's reacting the way it is? Well, we're going to get to that next. All right, and so the biggest market event that we had in the month of December was the Fed meeting. They get together, and they got together in December, and they actually cut the Fed funds rate. So you can see here they cut by 25 basis points, 0.25%, and now we're at 4.25 to 4.5. So we were at 5.5 about a year ago. And so this is good. We're getting interest rates down. But remember, the Fed is only controlling these very short-term interest rates right on the front end of the curve. And we're going to talk a little bit more about that here in the outlook. But it was what they said afterwards. It was their guidance. You see, the Fed is seeing what I'm seeing. They're seeing that, unemployment's low, we got decent jobs, inflation's getting kind of sticky, and the economy's doing pretty good. Why should we be cutting interest rates so fast? So they're kind of projecting that they're going to slow their roll here on how they're cutting interest rates. Instead of cutting 4 times, which is what they were predicting in their dot plots, now they're saying only 2. So the market's getting a little anxious about that, because they're actually thinking, well, what if they don't cut at all? What if inflation sticks and won't go down at all? And so we're going to talk a little bit more about what the ramifications of this are, and tell you some of my thoughts of what I think is going to happen. All right, so are we seeing any other ominous signs in other parts of the economy that would indicate why the stock market is going down when we see good economic data? Okay, I would say the answer to that is no, not really. In fact, I want to show you the credit spreads. This is the bond market. The bond market, Wall Street says, is where the smart money is, okay? And the credit spreads is the difference between what a corporation can borrow money for versus the Treasury, which is zero risk. So when it costs corporations a lot more money to borrow than the Treasury, it's usually when the economy is struggling, right? When there's a lot of risk in credit. And so that has happened in the past, right, around recessions. And so the last time we had that happen, where we had a little spike in the credit spreads, was 2022 during the COVID scare. We had a short little recession. But you can see here the credit spreads has just been steadily going down, down, and down. And I don't see any spikes. And that's usually a leading indicator to what's going on with the economy, and the stock market's starting to sniff that out. But we're not seeing that at all right now. All right, so not everything is rosy, all right? So here's the 10-year Treasury. It's just a good benchmark for what's going on with interest rates. And you can see that since September, it's been going up quite a bit. We're back up to where we were earlier in May and back in October of 2023. And the market did kind of have a little bit of trouble during those times, like it's having right now. So interest rates, the way I want you to look at it, is like a thermometer. It's measuring the heat of inflation on one hand and growth on the other. And so if we get inflation and growth that are hot, interest rates are going to go up. And that's exactly what's going on right now. And then you can see how there was an inflection point right around September when it looked like there was going to be a Republican in the White House. And then once there was the sweep, you could see how the yields really spiked up even faster. So that's the anticipation of potentially more growth because of deregulation, tax cuts, but also potentially a little bit more inflation if there are tariffs that are going to be affecting the inflation rate. We'll have to see. I think that aspect of it might be getting a little overblown. But the bottom line here is I think with rates above 4.3, I think it's causing a headwind to the stock market. We're going to have at least rates stabilize and maybe come down just a little bit for the market to be able to continue to go on this nice little streak it's been on. It's going to have a hard time if it keeps going up or stays at these levels, only because the stock market is at a kind of pricey point right now at 22, 23 times the forward earnings, which is historically high. So this is something that I'm going to be watching very carefully. All right, so bottom line, not really changing the implications at all More than anything, I'm just changing how quickly I move into these new positions. I am still bullish. We're seeing a strong economy, a good labor market. Inflation may be a little sticky, but seems to be going down lower, not higher. If we've seen a couple little blips going higher, I think they are more temporary. There is the concern about the tariffs and how that could inflate, cause inflation. I think that's being a little overblown. If there are a lot of tariffs, they're only going to be a one-time hit that's going to affect inflation, but it's not going to be a continuous hit over and over and over and over again every month, every year. And so I think that's being blown out of proportion a little bit. So I'm sticking to my bullish call, but I'm slowing my roll just like the Fed with how to implement this, adding the small caps, shifting out of growth, going a little bit more value. I'm slowing that down a little bit, but I am continuing with the movement in the bonds. Adding to corporate bonds. Now as the yields go higher, they get even more attractive, especially with those low credit spreads, meaning that there's not a lot of risk in the corporate bonds. Allocating from cash to floating rate bonds to capture those higher yields. But you know what? If we have a little bit of cash, I'm not going to be in a huge rush to get rid of it either, because it's got a good yield and it's probably going to stick around into the 4% range for a while here. So this year is going to probably be start off a little shaky as we figure out, what the Trump administration is really going to do. Or are they really going to get the bazooka out and just blow everything up? Or are they posturing right now to kind of negotiate better deals for the U.S.? We'll have to see. So I think there's going to be a little bit of that digestion here in the next few months, maybe the first quarter. But I'm still optimistic long term. So these dips, this choppiness, I think are going to be some good opportunities for us to dollar cost average into a little better prices than we've seen in a little while to take advantage of the rest of the year. All right. Hope this helps, guys. If you have any questions, feel free to reach out to me, share the video. But again, thank you so much for watching, and God bless.